12 months ago, everybody was expecting a number of rate cuts during the course of 2024. Do you remember all that far back, right? There was a lot of folks predicting 5, 6 rate cuts during the course of 2024. And here we are, not quite at the halfway point, but coming up pretty close. The reality is that there haven't been any, nor is there really much conversation about those rate cuts being anytime soon. And it's interesting because that expectation of where we thought rates were going to be 12 months ago, even 6 months ago, there was a lot of folks predicting that there would be 3 or 4 different rate cuts here at the start of the year. When the year started, the reality is that now it doesn't look like there's going to be hardly anywhere near that number. I think maybe one, and emphasis on maybe, because the other part of it, as we've said on this program before, the closer you get to a presidential election, the less likely that they're going to want to cut rates around that timing. So I guess it begs the question, what if the Fed doesn't cut interest rate? What's going to be the impact on your money? And how do you need to sort of prepare for that higher for longer type of an environment that we're looking at in terms of interest rates? Well, we'll answer that question on this segment of this week's episodes of Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs celebrated our 40th anniversary as a business earlier this month. Ultimately, we're one of the longest running radio programs as well, and a top 25 financial planning podcast on the World Wide Web. So make sure you check out our website, nelsonfinancialplanning.com. Once you're there, you can schedule a free conversation so that we can help you improve your life with a successful and cost-effective financial plan. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great people who also happen to be certified financial fiduciaries as well that stand ready to help you at any point in time. So I guess one of the chief benefits of higher interest rates is that if you've taken the time to shop around your cash, right? So your emergency savings, your cash money, you actually should be earning some interest on that, assuming that you have taken the time to kind of shop it around. If you haven't taken the time to shop around and you left it kind of sitting at your bank, then you aren't probably really earning anything, which would be a problem. You still want to make sure you're checking that out in terms of what you're actually earning in terms of that cash and savings at your bank, because clearly, depending upon where you put that cash, it's actually earning interest. But again, based predominantly on what the overnight lending rates are in terms of those Fed interest rates. So that's a clear benefit of if rates are higher for longer, then you're going to continue to earn a higher level of interest rate on those savings. On the flip side, if you will, unfortunately, that means that mortgage rates will probably stay in the 6 or 7% neighborhood. The reality is, though, that that's somewhat in line with sort of historical averages, so not that dramatically out of line. If you talk to anybody that had a mortgage in the early 80s, they'll tell you about 13, 14%. Those rates would certainly be very high indeed. But that also gives you some historical perspective of where rates are now relative to kind of where they've been over an extended period of time. Of course, the issue with higher rates, right? I mean, increasing rates, having interest rates higher is ultimately the economic impact is that it's intended to slow economic growth, right? We all kind of know that basic correlation of the Fed raises rates when it wants to slow down economic growth to prevent an economy from overheating, to prevent inflation from running rampant. On the flip side, the Fed starts to cut rates when they want to sort of hit the gas economically to encourage economic spending, economic development, all of that translates to when they sort of reduce rates or cut rates. The reality is, though, the U.S.'s economy has proven pretty resilient against the backdrop that we are in terms of the current interest rate environment. In fact, you could certainly argue that the U.S. results have been incredibly strong, especially in comparison to the rest of the world. The prediction economically for the U.S. economy for the calendar year 2024 is the growth expectation is 2 times and in some cases 3 times greater than what major developed countries in the rest of the world are expected to do during the course of the year. If you think of the U.S. economy expected to grow at around 2.7%, the flip side of that is that the European economy only expected to grow 0.8, less than 1%, and the Japanese economy expected to grow 0.9%. So U.S. economy growing at almost 2, actually 3x what those other major developed economies are doing. Clearly, the U.S. economy is showing some resilience in the current interest rate climate. Obviously, main drivers are consumer spending, manufacturing investment, things like that. But it's hard to ignore that progress on inflation is, in fact, stalling a little bit. It's sort of been stuck at 3% over the course of the past few months. The goal of the Federal Reserve is to try and get it down to 2%. We think that's going to be pretty hard. If you look historically at inflation, it's kind of averaged a little bit closer to the 3%, not the 2%. So that might really be hard to do that. And of course, if you start to cut rates, right, then you run the risk of increasing inflation. So the Fed is sort of continuing to sort of sit pat because that inflation piece is certainly not what it's desired to be. But economically, and certainly corporate earnings, as we were talking about earlier in the program, seem to all be hanging in there decently enough. The impact of inflation cannot be ignored. It is real. We talked about that postage stamp example earlier in the show. Fast food, another example. Since September, I was reading a statistic where since September, fast food, fast casual restaurants have increased prices by as much as 10% on average just in the course of just since September. Some areas, particularly say California, where they're trying to institute a $20 minimum wage, or they're in the process of instituting it, the inflation has been even more dramatic. My son, Connor, who is doing an internship out in Los Angeles right now, can certainly tell you that his tacos cost more now than they did when he first arrived in Los Angeles. So it is certainly a pretty significant impact that inflation is having. And that's why I think the Federal Reserve, more likely than not, to not cut rates, because when you cut rates, you run the risk of spurring economic activity and increasing inflation. So probably going to continue to stand pat, if you will. As we said earlier in the program, the reality is that the financial markets have sort of kept up with all of that pretty decently and haven't necessarily been thrown off by these higher interest rates. Even now, as we were saying earlier, the Dow has experienced the kind of the longest winning streak of the year so far in 2024. The broader markets have certainly hit a series of record highs during the course of this year so far, even against the backdrop of those increasing Middle Eastern tendencies. Historically, we're in that period where stocks have, in fact, historically done well, kind of following that pause of increasing rates. So if you think of where we are in the cycle, they're no longer raising rates, but they haven't started cutting rates. And it's that interim period of time where you actually have a market performance that's relatively decent. So when we return from the break, we're going to kind of break that piece of the cycle, the economic cycle, down and what it means for your money. So stay tuned through the break, and we will continue here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning. Stay with us through the break when we continue here on Dollars and Cents.